Good morning and welcome to the Business Lens with Rapid TV Abuja. It is great to have you with us on this beautiful edition. Business Lens is where we look at how all the numbers and figures directly affect you and your businesses. My name is Divine Alex. So let's begin with the key business trends that matter right now, starting from the headlines. Now, OPEC Plus has approved another increase in oil production for July, raising output targets by 188,000 barrels per day (BPD), and despite ongoing supply disruptions that was caused by the U.S. and Iran conflict and reduced exports through the Strait of Hormuz. Now, away from that, Nigeria's debt burden continued to strain public finances in 2025, with federal government spending 12.63 trillion naira on debt-related payments in the first 9 months of the year, exceeding the budgeted provision for by 1.90 trillion naira. Now, this data shows that debt servicing alone consumed more than 67% of retained government revenue, meaning that for every 100 naira, I said it earlier, about 67 naira went to debt repayment, while we have the revenue performance that also fell significantly short of budget targets. Now, these figures underscore the growing challenge of balancing debt obligations with funding for infrastructure, social services, and economic development. Now to the next, that says the foreign investment into Nigeria's telecommunications sector dropped to a 4-year low of $7.24 million in the first quarter of 2026, despite that last year's approval of a 50% tariff increase aimed at improving operators' profitability and attracting fresh capital. Now, this sharp decline from $80.78 million a year earlier suggests that investors remain cautious about committing long-term funds to the sector. And now this raises questions about investment confidence, infrastructure expansion, and the future financing needs of one of Nigeria's most critical industries. Now to the next, that says the sector foreign investment into Nigeria's manufacturing sector weakened significantly in the first quarter of 2026, with capital inflows falling 50.7% quarter on quarter to $152.27 million. Now, this is despite a surge in overall capital importation into the country. Now, these figures suggest that while foreign funds are flowing into Nigeria, we have much of the money that is targeting financial assets rather than factories, industrial production, and long-term productive investment that supports job creation and economic diversification. Now, in another development, oil prices retreated sharply last week Thursday as growing optimism over a potential expansion of Middle East ceasefire efforts eased concerns about supply disruptions. Now, the Brent crude also fell below $95 per barrel, while WTI dropped to around $92 per barrel, as investors bet that diplomatic progress could reduce risks to global oil flows and eventually support the reopening of the critical Strait of Hormuz. This is a key route for global energy shipments. And away from that, Nigeria's oil and gas sector recorded a 283.3% increase in foreign capital inflows in the first quarter of 2026, but the headline growth marks a deeper concern. The sector attracted just $460,000 in actual investment, despite being Nigeria's biggest export earner and a major source of government revenue. Oil and gas accounted for virtually none of the $10.37 billion in capital imported into the country during the quarter. This highlights persistent investor caution and the challenge of attracting long-term investment into the industry. Now, the next says the Central Bank of Nigeria has increased the maximum foreign exchange allowance for tuition payments by Nigerian students studying abroad from $15,000 to $25,000 per semester. This move, they say, is part of broader foreign exchange reforms that is aimed at improving access to legitimate FX demands, to also reduce transaction bottlenecks and boost confidence in the foreign exchange market, while providing greater support for families funding international education. And to the next, where Nigeria's aviation sector is facing renewed regulatory tensions as a dispute between the Nigerian Civil Aviation Authority (NCAA) and domestic airline operators escalates over the alleged unpaid statutory charges running into billions of naira. The controversy intensified after the NCAA issued a no pay no service directive against 11 airlines, including some of the country's biggest carriers. This raised concerns about regulatory relations, industry financial sustainability, and the potential impact on airline operations in an already fragile aviation sector. And now, away from that, let's head straight into the market, where the naira strengthened modestly against the British pound in the first week of June 2026, appreciating from around 1,845 naira per pound at the start of the month to 1,823 naira per pound by June 5. We will look at those stories and more after the break. My name is Divine Alex. This is Business Lens on Rapid TV. Stay with us. You are welcome back. This is the Business Lens on Rapid TV Abuja. My name is Divine Alex. Now, this morning's conversation focuses on the quality of Nigeria's economic recovery. While we have capital inflows that are rising and policy reforms, continue, the key sectors, including manufacturing, telecommunications, oil and gas, and aviation, are still struggling to attract meaningful long-term investment. At the same time, debt servicing remains a major pressure point for government finances, raising questions about sustainability, investor confidence, and the real impact of reforms on productive sectors of the economy. And joining me on today's conversation to break down this and to make you understand 100% what this entails is a global business analyst, Daniel Effa. Good morning, Daniel.
Good morning, Divine.
It's great to have you here in the studio.
It's good to be back.
Okay, so before we jump straight into the conversation, I want to get your comment on the OPEC Plus, because we have, I think it was the last episode or two episodes ago, we had to remember that at some point last year there was supposed to be an increase, and at some point it's looking like everybody just kept quiet, and we were asking, why is it looking like there's silence? And now there's this report saying that they have plans to increase by 188,000 per barrel. What is your take on that?
So I think that is insignificant, to be honest, in terms of the effect it would have on the market. However, we know OPEC is just about the pricing in terms of them managing supply properly, and we know what they have been faced with right now. And as early as of this morning, this whole issue has escalated again, and we started seeing attacks on both sides. And we've seen oil prices heading towards $95 per barrel, which I have always said it was that $90 per barrel was always a short stint. That it was definitely still going to test the overall. So as long as those issues are still there, whatever the supply OPEC is actually pushing is not that significant for a market shift, right? Because from what I'm finding out, some of those countries that are being affected by the Strait of Hormuz are even trying to show up supply, kind of. I heard Iran has about maybe how many million barrels outside of the Strait of Hormuz just to sell. So they have been affected on outside, but then there's a supply breach. It's not like there is inadequate supply or there is inadequate production. There's a supply breach, and a lot of these countries are still supplying. So OPEC is looking at, we don't want to increase it too much, so we don't have a significant cut when prices start coming down, because at the end of the day, as soon as this issue is over, prices will start dropping, because the supply, there might be, or else there might be a supply glut. In fact, OPEC would have to cut at some point in the later future to be able to balance out the supply that will come as soon as this whole issue de-escalates.
Okay. Now, let's go straight to the issue of the fact that Nigeria attracted $10.37 billion in capital importation, but we had about 100 million thereabouts for the FDI, which is that the portfolio investment went as high as over 90%. I know we've discussed this, but not maybe as detailed as this. Now, For sectors like telecoms, you know, the manufacturing and oil and gas that are still weak, would you say that investors are betting on Nigeria mainly, or they're just betting on Nigeria's financial markets?
I think that's what they are doing. When it comes to where global funds is right now, if you check at the stands, if you check, because of the high risk we faced from 2020 up to now, if you check, you realize that we've seen a lot of these assets, gold, crypto, doing a lot of numbers. But in the last 4 or 5 months, they've started de-risking. Like everybody is like pulling out funds. You've seen gold drop back to about 4,300. You've seen crypto. You've seen Bitcoin, for example, that was hovering around 90,000 to 100,000. Has gone back to around 40, 50,000. What does it mean? It means that people are taking out funds from risk, what do you call it now? Those what we call the safe haven assets. Asset that whenever the global economy is in serious turmoil, you want to save, you want to hedge your bets, right? So if you're taking funds out of there, that means you're seeing potentials in the global economy again, right? Everybody now wants to invest in something, invest in projects. That's why you started seeing high investment in crude oil related assets globally. I'm talking about global now. You're seeing people going into manufacturing more because then now that inflationary pressure is dwindling, has practically stabilized in the last 18 months globally, it makes sense to start pushing funds back into the real sector. Right, so but then that is where it becomes a bit funny for us now in terms of the fact that the kind of funds we still attract, instead of real sector funds, we are attracting funds that are going into the capital market. At least we are attracting funds. That first is a win.
Good one, okay.
But then the real funds, which actually is that can directly influence job creation, economic expansion, because if you're targeting a $1 trillion economy, and you need a lot of FDIs, right? So I think this is what the government needs to look at, because these numbers are appalling for a country of our standard in terms of population, in terms of capacity. We should not be attracting less than $1 billion, right? In fact, $1 billion is even too small. We should be looking at 5, 6, 7, 8, 9, 10 billion for you to say yes, at least something is coming in that can translate into real wealth for you people. Now, and in comparison to other countries, the sub-Saharan countries in our level, realizing that we are doing very, very appalling numbers.
Okay, now to think that we had the president say that, oh, we are going to attract 20 billion into the country on the FDI. But all of a sudden we are seeing these numbers, and then we also have had, you know, some institutions come out like the IMF, the World Bank, the S&P that also rated us, that might raised us from B- to B, you know, taking us away from where we used to be, you know, which caused, I think a lot of people even celebrated it. I even saw a tweet by Taiwo too, talking about how it is so great that we moved from this. Now, why is it so hard? Why are we still, you know, attracting more portfolios? Why have we not gotten to the point? Because this is June. If they said, okay, in 2026 we'll be able to get more FDIs, and then this is the 6th month, and we are still doing over 95%, 95.09% in FPI. What is there something you think we're not doing right?
Yeah, we are not doing a lot of things right, but I think the most what's the word? The most salient of those things that we are not doing right is infrastructure. Because what are the things that would usually attract FDIs, right? It should be your manufacturing, because in fact, if you check capital importation of manufacturing, it's less than 300 million, right? So if your manufacturing is a very key aspect, right? Construction, right? So because those are the points where people want to get to make money from, because of your closeness to the market, right? So in fact, at a point in this country, we had a lot of factories in certain cluster zones, and if you go back there now, a lot of them are practically dead because of infrastructure. Electricity is not there for them to use, right? So what we can do now, right, if you're going to still want to attract FDIs, we need to now look at the low-hanging fruits, which is what kind of industries, what kind of infrastructure, what kind of industries, what kind of business can we attract into our space right, without us having to fully solve our infrastructural issues, because infrastructural issues that are suffering from we have security issues, we have what's the word? We have the road networks is bad, right? We have electricity is a problem, right? So what kind of businesses can we attract that would rely less on this particular three infrastructure, which is almost impossible? But you get, for example, if you're bringing a business into the country, a business coming into the country, he or she's looking at how am I going to set up power supply? You get, so if you're going to be saying, okay, this is what you want, this is we want you to come in, then are we creating a cluster for you to have electricity in that zone? If it's a band A zone or something, just you get, if it's about areas, urban areas have better road network, it's about, okay, getting them closer to better road network. So those are the conversations that has to happen. We've seen emergence of rice mills across the country, so you can actually still look at agriculture as a place also you can actually attract it from. Now, all these conversations will not just happen. You have to go and sell yourself, right? So in recent times and most times before now, we've seen even state governors take up state visits to different zones to say, guys, come and do your business here, because this is what we get. We've had those scenarios, but how many of our state governors are doing that at the moment? Because so when you look at all those concerns, you realize that you cannot, even if S&P grades you, before you can get to you can leave the B you are currently in. Actually, you need to have infrastructure. In fact, part of the conditions that were given for us to move from B, from the B stable that we had to B positive, or let's say to B negative, for example, is that we must have solved issues of poverty, must have reduced poverty, not necessarily solved, but reduce it significantly, create a level of, reducing unemployment, reducing inflation, right? You cannot do all those three things without having some level of infrastructural investment done. You cannot just pronounce these things and say they are cleared and they are cleared. Even if you cook the figures or you walk around the figures, it will always still stare at you in the face. So
now, what specific risks do you think that is responsible for discouraging productive investment into Nigeria?
The risk is there. Of course, there is the physical risk, and there's also the fact that government policies have not been extremely stable. We don't have a very good perception in terms of globally in the way businesses are run here, right? For example, one of our most global businesses is Dangote Refinery. We've seen there's hardly a month in the last 2 years this business was set up, and there's no issue or the other, right? In fact, if you're looking at court cases alone, he has done over 50 to 100 court cases in the last 2 years, just setting up a refinery. So, if a foreign business looks at that conversation and just looked at the news, just Google, and it sees a lot of issues here and there from whether from regulators or from marketers. So those things have a way it gives a perception to a business coming in, right? So most of these businesses would not prefer to just drop in cash, right? They risk themselves, dropping cash into your market, get whatever 20-30% return that is risk-free, and just get their money back. So before we get to that point, we must have created a very strong Nigerian brand, right? Because creating a strong Nigerian brand is not just aesthetics, it's not just noise, it's not just having a lot of media team. No, it's about actually doing the work, right? And also publicizing the small work you are doing. So every improvement you put in, you are actually talking about it. So if in Nigeria, where, for example, let's also do a simulation, for example, like in the last 3 years, there has been considerable level of improvement on the road networks, for example. And the government is saying our roads are now connected. You can now do a 7-hour travel from Lagos to Abuja at 100 km per hour, you get for a 700 kilometer road, or do the same thing from Lagos to Maiduguri. There's security, nobody will kidnap you, and there's actually no issues of kidnapping of any kind. It would be easier for a business that has to do with logistics, for example, will come in. For example, a business that has to do with movement of goods, agricultural value chain, they will come in because they are seeing you get whatever you're doing. So it's a ripple effect. You cannot isolate anyone from the other. You get so, but then it's because we still have a robust capital market, we still attract you get the right funds at the right, and we'll keep attracting as long as that market it keeps being robust. Because to be honest, to be very, very candid, we've been very fantastic when it comes to our financial stability. That's what the CBN has done with tightening monetary policy and the other framework setup. The structure around it is fantastic. So we just need to begin to do the real groundwork that actually moves an economy from where it is to where it should be. Because no matter how you look at it, your market, your capital market cannot directly push your economy to the $1 trillion target. It has to be the people in the economy. They have to be extremely productive for them to be able to get there.
Okay, thank you for that one. Now, the telecom sector received just $7.24 million in foreign capital, despite the fact that we had a 50% tariff increase. Now, what message do you think this sends to our investors at once if they are just looking at, because it declined? There was no strong investment in the telecom sector, and this is one of the major sectors that we have that also assist us in the economic conversation. So what message do you think this is sending, and how can we get around it to actually send the right message to the investors to get them to come in to put their investment where we want them to put? Okay,
so I would not take the telecoms receiving low capital importation as a very big issue. Why? Because it's at least in the last 48 to 60 months, ICT, the entire ICT sector has been the saving grace of the Nigerian economy. They have practically been one of the most important sector that has held the GDP figures to a certain extent. So I think to some extent, when you look at when you grade growth, right, of sectors, I think the ICT sector, telecoms, they are at an advanced level, right? So for someone coming new, for an investor instead, I would prefer to just invest in capital markets, focusing on telecom stocks rather than pushing into the telecom, because there's little room. We are advanced here in terms of internet, broadband. We are doing well. At least we are competing to a certain extent. In terms of communication, you get infrastructure. We are doing well. You get, so generally, you get that sector is okay. You get, except there is a significant change or a new innovation or something extremely new. I cannot expect you get new investment. But if not, I think that's for me is okay. You get, in fact, the way it works with investments, the tendency of an investor, what an investor is looking for, is what will give me a quick return. You get on investment faster, and you would go to sectors where you have less competition, right, to make your money, right? So, but then the telecom sector has relatively large, robust competition. You see how big the telecoms are, the MTNs, the Airtel of this world. You get, so they are all doing well to a certain extent, and except they are importing machineries, you will hardly see investment coming from foreign investment coming in. Then if it is not the market, if it's actually the sector itself, it will be rare. But other sectors that actually needs it, are not getting it, and that is where the real issue really lies. Okay,
now the manufacturing sector also, the inflows also fell now by more than 50% in Q1 of 2026. And I remember that I said we also have something that we're looking out for, the fact that they said we're going to have to attract at least 20 billion in the FDI, and all of a sudden it's looking like we're not even anywhere close. Now the oil and gas sector also attracted only $460,000. What do you think is the issue here too? Is it the same issue of the fact that maybe some of those investors, that when they just want to go in for the hot money and then jump out? Why are investors avoiding sectors that traditionally drive jobs?
For the manufacturing sector, I think that it is basically electricity and road infrastructure. I saw the figures from PMI, Purchasing Managers Index, that shows that we did about 54 point something, which means that economic activity has actually expanded, right? So what we've seen over time is that manufacturers in Nigeria have gone through different phases, and they are in the resilient phase. That economy is stable. Let's just keep producing. Let us be pushing the costs, get the costs to the consumers, and we'll keep taking orders and keep producing as we can. Again, we've seen, for example, in the fast-moving goods, for example, we've seen brands have to adjust their output to start going to sachet content just to make sure that people are able to consume the product, right? We've seen them redesign the bags just to ensure that they are able to maximize efficiency. So when you look at that resilience, that local resilience, it takes a business that is there. It takes a Nigerian to understand it. It takes someone that is in here. They might not be a Nigerian, but probably has done a business in Nigeria for so long to understand how to. But if you are coming in as a foreign capital, as a foreign investor, you are looking at how am I going to cope without this infrastructure. So that is the real concern, right? So we need to. I think that we cannot suddenly solve issue of electricity by just waking up. I think that we cannot just suddenly start creating 50,000 megawatts. But I think that we can also identify clusters, identify cluster zones, identify industrial zones, and simply provide them with electricity enough for them to be able to get their output done again. So. And that I think that was always there before now. I think it was always there some years ago. I think it needs to resume. Businesses needs to know that if you're going to set up shop in Nigeria, this such particular zone is where it's most appropriate for you to set up, right? So that first gives an idea into anybody coming into the country to say, okay, this is the funds. And what I'm particular about is conversations. I think that we're not doing enough conversations with businesses that can do business in Nigeria, right? Because, for example, we have a large market for Chinese goods, right? Chinese goods, for example, are in a very, we have so much partnerships. We have a lot of businesses that practically get, there's some factories in China practically set up just for Nigerian orders, right? Those are kind of businesses that can do business here, right? And I'm surprised that it's in this current administration, we've not had an official conversation with China up until maybe recently, but the last administration had a very close relationship with China. I don't know, so we need to be more business-like in our approach, right? We're not going to beg anybody to bring funds here, right? Because you cannot beg them actually. So, but then you need to give them what are the incentives, right, that can drive businesses. If it's tax holidays, give them tax holidays. Of course, the concern, the fear is usually them coming to them coming to kill local businesses that are already set up. But then, so why helping the local businesses boost? Well, so because when they complain, you don't respond to them. So whenever you're looking at FDI, you're looking at it also from the internal, like what exactly. So except for industries that we have almost zero local businesses trying to push, right? You need to help them also. So some of those businesses might not necessarily have to be they might not have to be setting up new businesses. It might have to be you investing in existing businesses to scale better, to be able to get. So the way we have foreign actors, so many foreign companies trying to come and drill our gold. Why can't they also drill other minerals that we also have? Those are the kind of, so if just those kind of deals that should come up that will at the end of the day do two things. It does two things. It will definitely it would create a local market for certain products, and also it will employ people. In fact, as long as people are being employed, you are almost certainly sure that your poverty conversations would reduce drastically, and that is just the point of call.
Okay, thank you for that one. Now I have one last question. Now, is Nigeria becoming an economy that attracts capital seeking high returns rather than capital seeking to build productive businesses? I just want you to. Yes, that is where we are. Straight. That is where we are at the moment. Whether we'll get to the FDI point is left to be seen. But where we are right now is we are doing so well financially in the financial markets, in the capital markets.
everybody just our bonds are relatively high, our treasury bills are high, so let's just come and pick up the money.
Now, do you think that from now to the end of the year that we'll get to a point where we'll at least attract the 20 billion? That
it's not possible. We won't even attract 20 billion in 3 years.
What about
in 3 years?
5 billion.
5 billion is not possible this year anymore, because what are the risks are quite high in terms of the figures. Yeah, so maybe going into the new year, and 2027 most of the time is usually an half year, right? So when you're looking at that kind of optimism, maybe 2028, because 2027 government, there's elections, everybody takes half of the year to whatever government change anything. Then you get the new government comes in and start working maybe from May, June, right, into the new year, get a supplementary budget, and okay, so any actual work will now start from 2028. So for us, let's just keep getting the foreign portfolio that we get, and we'll keep getting excited about what.
Okay, thank you so much, Daniel. Do you have anything that you want to add to the conversation as regards to the fact that we keep attracting more FPIs and FDIs, and somehow some sectors are suffering, like the telecoms and the manufacturing and a little bit of the oil and gas sector?
I think that based on I think it was the second story about the debt, the high debt, I think that government needs to start seeing it as a proper businessman. Would I want to keep incurring debt to push my business, or I would just want equity stake in my business? So instead of incurring so much debt that you have to repay, I think some of those projects has to be concessions, has to be joint ventures, right? So if you're saying your plan for infrastructure is 10 trillion, for example, and you see that this infrastructure, yes, will boost the Nigerian economy, get concessions, just like the former Minister of Works talked about the other time. Get private partnerships for this kind of deals, then they can toll the roads, right? So instead of spending, that would reduce your spending by almost 40, 50, 60%, right? So that way you wouldn't have to be too worried about spending on infrastructure. So I think that is what the government has to start applying now, or else we'll get to a point that we are not, because we're not making enough revenue, and that is the problem. Exactly. Yes. So if you're making enough revenue, it will make sense if your debt, because your debt keeps rising. Because as long as you're not making revenue and you have some certain costs you cannot avoid, you keep incurring more debt, and the debt will keep affecting you from even generating more revenue. Because how do you generate more revenue from a country that has a very high poverty rate, right? A lot of unemployed people. A lot of people are saying they are unemployed because of what MBS is saying, 1 hour per week, right? But then a lot of people are unemployed. A lot of people are not productive at the level they should be, and that alone is a problem. It's a ripple effect problem you get on the pockets of the government. So instead of worrying a lot about healthcare and all those infrastructural things, you need to do some of concession. Get companies that will have a concession, or even bilateral agreements with government on concessions. Let them fix the road, or they fix the infrastructure. You can now have a partnership on how to toll till they recover whatever they want to recover. You have to start thinking as a businessman, because we are where we are, and we need to keep moving forward. We need to keep moving forward. Thank you so much, Daniel, for that one. And the numbers tell two very different stories. On one hand, we have Nigeria attracting more foreign capital and pushing ahead with reforms. And on the other hand, we have many productive sectors still struggle to attract meaningful investments, while debt continues to consume a large share of government revenue. The critical question for policymakers is whether today's financial gains can be converted into tomorrow's jobs, industries, and sustainable economic growth. That is all we have for you today on The Business Lens on Rapid TV Abuja. My name is Divine Alex. Do follow us across our social media platforms, and don't forget to stay with Rapid TV. Bye for now.